Good afternoon, everybody. As we get started, I'm just opening up the Q&A box. As a reminder to everyone on this call, if you are interested in asking questions, there is a box on your toolbar that will allow you to ask a question. I'll be monitoring that. Since I'm doing this alone today, I'll try to monitor it as closely as I possibly can, but I want to thank you all for joining. Today, we're going to be talking about the changing world of investments. So there's going to be a little bit of a history lesson as well as some thoughts on a framework of how to think about investments from the perspective of the product side, not just the side of asset allocation and the like. With that, what I want to make sure that everyone understands is that what I'm going to talk about today does not necessarily mean everyone on this call should do it specifically. I'm going to make general comments, for example, about the difference between mutual funds and ETFs. We use both of those. I don't want anyone running down the path of, oh, I only can do one thing or the other, or something doesn't work for, doesn't make sense when they make sense in different circumstances. So I'll try to touch upon some of that, but just want to make sure that everyone is checking back in with their financial advisor and making sure they understand what's going on. As a quick introduction, my name is John Meyer. I am the president of the wealth management team here at BGM. And if you remember, BGM is a lot of things. We offer solutions in the world of CPA side, outsourced accounting, 401k and retirement plans, trusts and estate, as well as the wealth management side, which is the side I run. If you ever have questions on any of that, feel free to reach out. Today, we have an agenda that gets into the depths a little bit of what actually is going on with products in our space. I don't think this gets talked about enough. People don't really understand what's in their portfolio. So I thought it would be fun to kind of go through this from that perspective. We'll start with a little bit of a timeline of how products have been developed, going all the way back to the 1920s. I'll get into a little bit of a trend issue and then do some analysis of the different types of products that you can be investing in and what they look like from the standpoint of fees, liquidity, tax implications like that. We'll do a couple of wrap-up slides where we talk a little bit more about tax efficiency, some of the trends and innovations coming up the pipeline. And with this session, I hope you just understand better where the world is from an investing standpoint. And today, I built this slide deck based off of just my observations over the last 25 or 30 years. So I'm hoping I can add a little bit of value. Let's start with a timeline of where things have come from. Back in the 1920s, the first mutual fund was devised. It still is in existence, the MFS Investors Trust. And then in the 70s is when we started to see the concept of an index fund. Now, when the first mutual funds came out, they came out as active funds, meaning the manager would pick actively the stocks or bonds in that fund. And in the 70s is when the idea of the index fund came about. That was John Bogle's creation, where he said, we're just going to buy an index or buy a pool that stays static. And everyone said, oh, that's a passive way of investing. Now, I'll take issue with that. Active index funds are not passive because they have to, at some level, have a formula as to why a stock is in or out of the index. If you think about the Dow, for example, the Dow is made up of the top 30 stocks. But if you think about it, the board of the Dow decides what those top 30 stocks are. So in some way, there is an active approach. It's just that there's not someone picking daily. But the minutia there sometimes is not worth arguing about. So index funds are considered more passive than the active funds that started in the 1920s. Also in the 1970s, the 401k was created. Most people think of this as something that actually started in the early 80s with the first 401k account, but the actual Revenue Act that created it was in the late 70s. Then in 1990s, we come up with the exchange traded fund. Now I'll get into the details of the difference between a mutual fund and an exchange traded fund, but it took that long. And I'll come back to it as to some thoughts on why it should have maybe been the opposite direction, quite honestly. Um, in the 2000s, we started talking about separately managed accounts more, or what we now might call direct indexing. Again, I'll get into that, but basically what that is the ability for a manager to buy individual stocks or bonds specifically for your account only. It's a little different than the pooled approach of a mutual fund. In the late 2008s to currently, basically, we've seen an explosion more so on the ETF side. So even though ETFs came on later in the 90s, the reality is the explosion has occurred in ETFs, not in mutual funds. And I say that from the standpoint that mutual funds are losing ground a little bit. I'll comment more on that, but mutual funds aren't completely losing ground. So I'll touch on that as well. And then finally, we're starting to see in the last decade or so much more focus on private equity and private debt. It's definitely starting to go mainstream more. I'll talk about that a little bit as well. So when you look at the evolution of the product set, what you'll see is in general, the movement from the 20s, where the first idea of a mutual fund came about, to today, you're going to kind of see diversified mixes of different things as we move through this. If I could put another line on this, it might even be there's some tax efficiency picked up as you move along here based on the kind of products they are, until you get to this private equity idea a little bit. But in general, the innovation has moved in this pattern. Now, what I would also add, and you can see the takeaway at the bottom here, is that innovation basically is trying to solve a previous pain point. So the pain point of active mutual funds really is that someone thought there could be a cheaper way to do it and still get access. And that's where John Bogle came into play with index funds. Then John Bogle's idea of index funds was viewed as, wait, there's a even cheaper and maybe different way from a tax perspective to do this. And that's how ETFs came about. Once you had that, then people started saying, yeah, but I want more customization. And that's where separately managed accounts came about. And over the last 2 decades, you've seen ETFs explode, partially because a mix of all this. Part of it is ETFs basically democratized investing a little bit. They brought the cost down, but they also allowed people to specialize. So you could be in an ETF, for example, that just does cybersecurity or just does some kind of healthcare. And that's a little more fine tuning of a portfolio if people want it. And the current pain point that private equity is trying to solve is that all of these things are investing basically in the same stocks. If you think about it, going back a couple of decades, there was probably over 10,000 stocks in the market. Today, it's I think a little under 4,000 stocks. What we've seen over the years with stocks is that as interest rates were so low, it was easier and somewhat less expensive for stocks to just stay private, or companies to stay private. So instead of IPOing and going out on the stock market, where it's a little more expensive to manage your company, pay for all the regulations, these companies, as they've merged, have not been replaced by new IPOs. And so the investable stock market is shrinking. And that's why private equity is becoming more of a focus in today's world. If the public markets are shrinking in what's investable, then how are we going to get access to the next coolest, best idea? And private equity, could offer something like that. So as I get going, that's the timeline we're running with. Now let's talk about the individual tools themselves. And I'm going to start on that timeline with mutual funds. Now, a mutual fund is simply a pooled product where, whether it's stocks or bonds, and actually it doesn't have to just be stocks or bonds. It could be different types of options contracts, especially when it comes to commodities. So there could be other things in there. But in essence, it's a pooled product where they buy or sell the underlying stocks, bonds, options contracts, and they pool everyone together in that product. And so basically, you as the owner are a part of what everyone else sees as well. You get daily pricing, but it's at the end of the day. So if you make a trade, you get to experience that trade at 4 o'clock in the afternoon when they actually price all the underlying investments and say, here's what you traded at. Now, as I get into exchange traded funds, you'll see that there is a different way to do this. But when you buy a mutual fund, it doesn't matter what time of day you're buying it or selling it, you're going to get pricing at the end of the day. That's a little bit of a disadvantage, sometimes an opportunity, but it can be a disadvantage if you think you're selling at a price, the market drops, and you really get a lower price. So that is the disadvantage of mutual funds. The advantage of mutual funds, however, is that the ability to have a very diversified product and do things that you couldn't normally do. For example, in bonds, oftentimes we want the manager of the bond fund to be able to go anywhere as opposed to being locked down into one type of thing. Today, a certain type of bond at a certain interest rate makes sense, but tomorrow it might not. And so having the ability to let these funds do what they need to do allows us to basically have access to some of the best minds in the world and manage the underlying assets accordingly. Now, in general, you'll see across the bottom here, mutual funds are still, whoops, sorry, I bumped that. Mutual funds are still the dominated product in 401k plans. And that's why I wrote on here, the death of the mutual fund is exaggerated. Everyone talks now about ETFs, sometimes this direct indexing, but the reality is mutual funds are still the underlying product in all 401k plans. You're starting to see some other minor changes to that, but I wouldn't expect that to die anytime soon. And if you think about it, the 401k world, everyone is adding money out of their paycheck every 2 weeks. So these products continue to grow that way, even though in the other side of the house, you're seeing more and more wealth management firms and even large investors pull money out of mutual funds in favor of ETFs. But I'll step into that when I get to the next slide. In general, what I would say with mutual funds is that fees are fairly inexpensive. They've come down a lot. And so from our standpoint, I will say that this is looking much better than it used to. But from a fee standpoint, we got fees generally around 0.5%. Some, when you get into certain really active things like maybe international space or something, could be above that. But we're seeing a lot more less expensive stuff these days than we ever used to. The negative is there's capital gains distributions on mutual funds every year. By law, they have to distribute 95% of their income and gains. So if and this is the negative to mutual funds, if the underlying manager says, I don't like an investment and they sell it, whether it's a gain or a loss, that passes through. But similarly, if the shareholder next to you wants to sell out, they don't participate in that distribution because they sold, they're gone, but you do because you held on. So from a tax perspective, mutual funds can have some distributions that create a tax issue, and that can be negative for people, especially in higher brackets. So mutual funds, we still use a lot of because there are things that mutual funds can do better in some ways still. But the answer is it's probably become more and more of a placement issue. And I'll get to that in a slide down the road here. But you may not want to hold just mutual funds inside of your taxable accounts because they will kick off a bit more annual distributions. As I move up the ladder a little bit, let's talk about exchange traded funds. I've referred to these ETFs. ETFs, I call a better wrapper to a mutual fund. If I had my druthers back in the 20s, the ETF would have been invented instead of the mutual fund first, because I think ETFs are generally a little better wrapper since they in general are going to be, they have 3 advantages. The first being they trade intraday, meaning that when you buy or sell, you get the price at that moment. They are constantly evaluating the price, the underlying prices of all the individual stocks or bonds inside of there, so they can give you the price in the moment. That's an advantage for traders, but it's also potentially an advantage just from a control standpoint. So you know what you get when you do it, right? Secondly, They tend to be lower cost by a lot than even mutual funds in many cases. Now, not completely true. The exchange traded funds started out as more of just a passive index approach. And then we saw a proliferation of what we call active ETFs. Active ETFs are simply a fund manager who wants to trade actively on their ideas inside the ETF, but still give you that constant daily pricing. And they're a little different because of the fact that you got a manager making a decision. It's not following an index. So think of ETFs as there are, varieties of ETFs. So you want to be careful when you're buying these to know what you're buying, whether they're passive or active. If they're active, there's a bunch of other issues. The cool part, though, about ETFs is the tax side. So unlike the mutual fund, the ETF has this ability to do what they call in-kind creations, meaning if I want to get my money out, they may look at me and say, okay, we need to sell some stocks because he wants his money. But instead of selling stocks, they could look at it and say, wait a second, we could actually trade out a stock that we don't want for a stock we do want and maybe affect the same issue. And so what they're doing is a swap of something like kind instead of creating a sale. Therefore, they never have a capital gain yet. And so from a taxability standpoint, they have this ability to swap stocks back and forth with other institutional managers. And therefore, the distributions annually are oftentimes way less and sometimes even non-existent compared to a mutual fund. So ETFs oftentimes are what we like to put in more taxable accounts for that reason, because of the ability to have probably a little bit lower capital gain. The one cautionary thing I'll point out with ETFs is the liquidity issue. Now, for big ETFs, like the stuff that we typically are thinking about with the S&P 500, let's say, you're going to have a lot of people owning it. Therefore, there's a lot of liquidity because the broad market exposure. But when you get into these niche ETFs, where people are buying, for example, just the cybersecurity stocks or just the, small banks in the Midwest, or however you want to think about some of these niche products, the reality is that you can have a very tight market. It's not broad at all. And therefore, if the pricing of those individual investments underneath freezes up at all, you might not be able to get out of your ETF quite as easily. Or if you do, you get out at a deeper discount, meaning you're selling for less. When the reality is maybe the market didn't move against you as fast on the underlying stocks. So I bring it up only because people don't understand this. And there's some tricks to trading ETFs that I'm not going to dig into too much, but for example, one of the main things that makes mistakes people make is they log in and buy or sell an ETF in the first 30 minutes of the market at the open and the close. And we try to avoid that a little bit because you tend to see more volatility in those early moments and later moments of the day. So those are the kinds of issues that come out with ETFs. But I do think from a cost and a tax perspective, ETFs are probably the better wrapper to what the mutual fund's doing. They both can own the same underlying stocks, bonds, commodities, things like that. Now, as we step up that ladder, the next step would be this idea of a separately managed account, or what I call direct indexing. And really, this became an issue because people wanted more personalization than a mutual fund or an ETF. In general, all a separately managed account is if you think about it, a mutual fund manager or an ETF manager says, hey, I'll manage your money on the side and buy you the individual stocks and bonds that you'll directly hold in your account. So you actually own those underlying individual securities instead of the pooled version of those. In fact, many mutual fund managers have a separately managed account option if you ask them. Now, typically the fees could be a little more expensive because they're going to charge a little bit more. Usually they got a little more administrative work when they're trading individual accounts. But in general, that's the issue. Also, typically you're going to see slightly higher minimums. In mutual funds, you can get in for almost nothing. Like you got a few bucks, put it in. Whereas in these kinds of things, you can get in at 50,000 or 100,000, but oftentimes I'd say if you can't put at least 250,000 into this kind of thing, don't do it. So typically, when a client wants to talk about this stuff, I'm talking about it when we can allocate, if you think about a sleeve, at least $250,000 of a sleeve, which means if you're investing, let's say, some percentage of something, they've probably got to have a few $1,000,000 in assets before these things make sense. But that's kind of how I would think about it. From a tax perspective, the one thing you can do here that's a little different is you can actually do a little more targeted tax loss harvesting. And so in general, when you look at it from that perspective, there's always, individual stocks in a portfolio, whether they're in a fund or in this product, that are probably losing while others are gaining. Well, this one allows you to, target the losers, sell them, and take your tax loss each year against other gains, or bank those losses for future use. But that does come out in this kind of product. Now, lest you think this is the beautiful answer, it is. In about 6 or 7 years of owning a product like this, you'll find that tax loss harvesting kind of whittles away, because what happens is over time, markets tend to go up. And so over time, you tend to see the ability for, well, you tend to see things mature enough that it's just everything's got capital gain in it. There's just not a lot of losers anymore. And so while it sounds good on the front end, over time, you'll find that you may not have as much tax loss harvesting in the future as you did early on. The one other thing I'll point out is these products can be used for more customization. We've seen this in the last few years with this whole idea of ESG, where people want to buy things that are unique, friendlier maybe to the environment, that kind of thing. But also it could be more customization in general. For example, let's say you work for a large retail company. Let's just pick, Target. You work for Target, you get Target stock. Your exposure to the retail industry is already high because of that. You might use something like this to say, okay, I'm going to exclude all retail stocks because I already have so much exposure over here in my Target stock that I don't want more retail. And so you can fine tune these things to do that kind of stuff, where you exclude things or include things you want to do. So these can be useful from that perspective. Jumping into the highest costing strategy, as well as the probably most recent and most unique, is the idea of private equity and private debt. When we say private equity, it's kind of self-explanatory. It's, owning the stock of a company directly. They're not even on the market yet. Debt's similar. There's plenty of companies out there who can't get money or won't get money from a bank. And so they go to other alternatives. And oftentimes that would be these investment banks, private equity firms, for debt that they need. They want to borrow, they just can't borrow from a bank. And so they're willing to borrow at much, much higher interest rates from these private opportunities because they have something that they're trying to do where they think they can pay it back no problem. And so private debt's become hotter in the past few years. But when you look at these alternatives, basically we want to think of a couple of things. First of all, they are illiquid. If you can't hold on to something for 10 years plus, and I say plus because in general, what they'll do is a 10-year holding period. But then in the fine print, they'll say, we have the right to extend that in 1-year increments for X amount of time. And so you might end up holding this stuff for 15 years or more. So you have to be willing to have that illiquidity issue. Now, the return potential is higher. That definitely is still there. And that's why people want to do this stuff. When you put this in a diversified portfolio, this added risk and added return potential does add a diversifying factor that's pretty interesting from our perspective, but I will say that that's what's going on. The issue too is that these are limited though to accredited or qualified investors. And the way I would think about this is, under the rules, you got to have a certain amount of liquidity and worth so many millions and stuff. Here's what I would say. If you don't have at least 5 million of investable assets, you probably don't want to do this. That's kind of how we talk to our clients about it, because of the fact that you still, in order to put a decent chunk of your portfolio into something like this, let's say you said, I want to commit 10% of my portfolio to private equity, 10% of 5 million is 500,000. It's enough that it'll have an impact, but it's not so much that if it doesn't work exactly, you go bankrupt. And I think that's the trade-off you got to think about. Now, what's interesting in private equity is the fees are definitely higher because oftentimes you're going to see this 2 and 20 structure where they get a 2% annual fee, plus they get to keep 20% of all profits. So there is a higher cost oftentimes. Again, their idea is they'll give you higher returns, but that's always something we have to hold out and see for, right? The second thing is there is a tax issue here. Now, you get to defer the gains. That's nice. But here's the thing that bugs people more than anything with these things is that these are partnerships typically. And so you're going to get a K1 every year, which means if you don't get your K1 on time, you're extending your tax return. So I have seen quite a few people get frustrated that they don't have a good K1 in their hands. And therefore, that is an issue that I want you to keep in mind. I will also comment, I'm talking about the purest forms of private equity and private debt with partnerships. We're starting to see other types of investments come out where they say it's private equity in the form of almost a mutual fund or an ETF. But one thing I want to point out in that is that whenever you monetize something in that way, where you say, okay, I'm going to give you immediate liquidity, but it's similar to something else, the reality is it's not similar to something else. Because the immediate liquidity means you're now somewhat tied to the stock market. And if the stock market from a volatility standpoint drops down fast, you're probably going to go with it, even if the underlying investments are still solid. So I want to point that out. The whole point to private equity and private debt that makes it interesting is the illiquidity. That's what allows, hopefully, for higher returns, is that you get the illiquidity. And what I would argue from a thought experiment, if you look at people's behavior, if they're always looking at the stock market and saying, oh my gosh, what's the market doing? It's going up, it's going down. That's what causes people to probably have a little bit of anxiety day in and day out. But one thing I like about private equity is that because of the illiquidity, they don't reprice this stuff more than quarterly. And so I've noticed people just don't pay attention as much, and they kind of just let it ride its way out. And over time, the returns are the returns, and it's a lot. I think it breeds a little less anxiety. So behaviorally, I like private equity for that reason. But just something to think about as you consider something like this. I'm going to give another comment about private equity on a different slide. But what I did here is I simply took all these and I've put them together, mashed them together in a little bit of a chart here so that you can kind of see all these issues together in one spot. And if you look at it from this perspective, you can see from a minimum investment perspective, how as we go up the ladder, you kind of start to play in a different world in relation to the minimum investments you need to get into this stuff. From a liquidity standpoint, you end up with, daily or even intraday on up to, hey, you're not going to be able to see much. Transparency wise, mutual funds tend to report their underlying holdings quarterly. ETFs tend to be daily, although those active ETFs, some of them only do monthly or quarterly. Separately managed accounts are real time because you own the underlying stock, so you can see that in real time. And then private equity or debt typically is quarterly. Fees are subjective, so I kind of just said, here's kind of how the fees roll from low to high. Tax profile is kind of subjective a little bit. And tax profile, I'll also point out, is somewhat an issue of individual people, right? Some people may not have a lot of tax issues, and a mutual fund distribution doesn't affect them that much. So when I say these things, I'm kind of saying you got to go and look at your individual situation. And then finally, who the ideal investor would be. In mutual funds, retail investors and retirement plans are still, using these a lot. In ETFs, retails, professionals like us, we are using more and more ETFs in portfolios. People in tactical portfolios love these because you can trade in and out of certain things very cost efficiently. And then people that just are really, really, really sensitive to cost, ETFs can be the cheaper answer to things. As we get into the SMAs or separately managed account side, we tend to see more high net worth people doing this. I occasionally see other people doing it, and I don't love it because you're basically doing the same thing then that an ETF could do for you, and that's probably cheaper. And then private equity is definitely more for accredited investors. But that is when I say seeking higher alpha, what I mean by that is people that are trying to get a higher return on purpose, and are willing to take that illiquidity in response. So this is just a nice summary. And when I look at it from a taxation perspective, I wanted to just kind of, again, this is just my thoughts. It comes down to which things are more tax efficient, what things are less tax efficient. This is a subjective thing. So I'll talk through it for a second. ETFs are very tax efficient. I kind of mentioned that. They hardly ever make a lot of distributions. So the only time you experience an ETF cost is when you actually sell it and have a capital gain. That's not a bad deal. Separately managed accounts, probably a little more control, quite honestly, because you can do some tax loss harvesting. So those can be effective from a tax perspective. Index mutual funds versus active mutual funds are the differentiating issue here. Index funds tend to have less distributions, tend to be a little more efficient tax-wise versus active. That's why I put active a step below that. Private equity, a step below that. And the reason private equity and private debt are slightly on different steps is because private debt, because of the higher interest payments debt gets in this world, are distributing income every year. And since they're distributing higher levels of income, they are distributing a higher tax problem every year. So I kind of put private debt on the bottom versus equity on the bottom. So that's kind of how you play it. Now, if you think about it, asset location is going to matter. When you look at this chart, it starts to tell you a story. And that story really becomes a question of the location, not the asset allocation, but the asset location. If you think about the asset allocation, you should have an asset allocation across your entire family, your entire household, however you want to think about it. And then within that, you're going to have a location. Some of these investments, you might own all of these investments, but some of them go better in certain spots to make your most tax efficient answer. So I kind of came up with this chart where I look at it and said the most tax inefficient answer is private debt because of the high payments and taxable bonds. Therefore, because of these things, dump those in IRAs. It's a little counterintuitive. Everyone says, well, I want to grow my IRA. It's tax deferred. True. But if you're going to put them anywhere, I'd rather put those higher growth things in taxable accounts because, again, if I do need them, I can sell at capital gains rates, which are cheaper than income tax rates. Secondly, I get this step up in basis at death. So let's pretend that I get to the point where I die and I leave this estate. All the high growth stuff that hopefully grew a lot in my taxable account gets stepped up to my date of death, and all that capital gain just gets wiped out. So I'd rather put the higher growth stuff there and hide the income stuff, which would be income on my tax return in IRAs. Then, do I want ongoing loss harvesting? If I do, maybe I've got these separately managed accounts or direct indexing. And if I do also want other higher growth investments, do I have Roth accounts? So I would separate on this high growth stuff in your taxable account. I would separate small international, small cap growth, international, and private equity, if I've got Roth accounts, I might dump those. Whoops, gotta go backwards. I might dump those accounts into the Roth side of my life because Roths grow tax free forever. So why not have the highest growth opportunity stuff there? So this starts to give you a bit of a framework for how you could be a little more tax efficient, because keep in mind, at the end of the day, your gross return minus taxes, inflation, and fees are what you keep. So if we can add to that pile by just less tax issues, you get to keep more. I'm going to close out with a couple of slides, one on innovation and then one on takeaways. So if you do have questions at all, now's the time to drop them into the Q&A box. From a trends and innovation standpoint, we are seeing over the past few years active ETFs become more popular. Our firm has not used active ETFs yet much. We tend to use more of the indexed version or the passive ETFs. However, we are asking that question internally and saying, are there scenarios where active ETFs make more sense? For example, in certain asset classes, there could be disparate information, such as in certain international asset classes or emerging markets. An active ETF, because they'd be trading on that information, might be a better answer than a passive. So there could be that scenario where I'm like, I kind of like active over passive. So that's where we are looking. And I just point that out because you're seeing more and more of that come up. Second thing is fractional shares kind of became a thing a few years back. And with that, this idea of a robo-advisor, we're seeing more and more of that. Now, here's what I'll tell you. A robo-advisor is simply an automated way to trade, right? It's still probably just a portfolio of ETFs or something. But the big brokerage firms of the world have come up with this way to say, you put your money in, we'll allow you, or we'll give you the model and we'll just trade it for you and stuff. Here's what I want to point out. A few years back, there was this idea that the robo-advisor would completely change the world and wipe out us financial advisors. The reality is that's not true at all. People still want a human being because they still got a lot of other issues they got to deal with. So it's like a funnel of information. What actually applies to you is what they're trying to figure out. B, I want you to be a little cautious of robo-advisors only from the standpoint that everyone is made differently. Everyone decides, for example, how much cash to hold. And there have been some situations you've seen in the news, maybe even, where some of these hold more cash than others because cash is a hedge. They actually make more money on the cash part themselves, but that hurts your returns. So if you got high cash in these things, when the reality is you think you're fully invested, that's a problem. So I just want you to be careful that you don't run down this path where it's like, oh, I want the automated answer, but it can actually bite you. The third thing is thematics are becoming definitely more of a thing. And ESG was a start to that, but really we're seeing more and more of it in other ways. Themes have come up about, current theme, of course, is AI. Everyone wants to have some kind of investment in AI. But even in healthcare and some of the other theme opportunities out there, these are definitely becoming more important in many ways. We're seeing that in the kinds of ETFs that come to market, for example, that is a product where they can specialize very easily. What you guys haven't seen a lot of yet, and this is kind of a forward-looking thing on my part, is tokenization and interval funds. Now, interval funds are in existence. There's not a lot of them yet, but they are in existence. And it's a way to have the private markets, in essence, come down a little bit in size so that someone wouldn't have to put quite so much money into something like this but still have access. Now, if you remember earlier, I said, if you take private markets and you dump them into a mutual fund, they're less effective because now you're just trading with the current market volatility. What an interval fund does different, and the word interval is the key, is that they basically lock it up the same way a typical private equity fund would. They lock it up so that you don't get liquidity except for every 90 days. The difference is it's 90 days instead of a 10-year hold. So every quarter you have the opportunity to get your money out if you need it, but it's just once a quarter. And they can also restrict how much goes out. So let's say they say you can get your money out as long as not more than 5% of our shareholders want to pull their money out. So there can be rules like that. But what interval funds do is they do maybe bring, or what I might say, democratize private markets a little bit and bring them down closer to what the mutual fund looks like. These things, we're looking at them. We haven't jumped on them yet, but we are looking at them. They're an interesting twist that could make sense. And when I talk about private equity being for portfolios above 5 million, interval funds would allow me to maybe add these kinds of things to much smaller portfolios and add some diversification. So I just bring it up because it is out there. Whether you've seen it or not, it is starting to come into play. And I'll throw tokenization in there because in this world of tokens and stable coins and all the things that have come out with Bitcoin and everything that's happened in this world, you know, the idea of tokenizing a company and basically saying, okay, we're not going to trade shares, we're going to trade the token, which could literally be fractions of a share. Whether we get there immediately or not, it is an interesting idea to watch because it would allow us to trade more smaller amounts. It would allow people to get into investing much quicker, maybe. So tokenization is interesting, but you could also tokenize different things then. It wouldn't just have to be the company shares. You could tokenize income streams. You could, for example, tokenize a baseball player's contract. I want to buy a share of that baseball player's contract, or I want to buy a share of the Minnesota Timberwolves income stream. Like they could do that. And that's what's interesting about tokenization. It does open up the world of investing in a different way. So I just throw that out there if you hear of anything. Finally, I'll close with strategic takeaways, and then I do got a question or two. So if I could think about strategic takeaways, I think one of the things I would point out is there is a difference here in passive versus active. But if you're just talking about core market exposure, like large cap US, small cap US, maybe ETFs are a really good answer for a lot of that because there isn't a lot of disparate information in the US on this. Like everyone knows that Apple and Google and Microsoft and 3M, like everyone kind of knows what the issues are with those companies and that their financials are good and whatever. So from that perspective, using an ETF and just buying the index on some of those makes a lot of sense. And you can kind of keep your costs down that way. The way I always think about building a portfolio is what's my budget? Let's say that I'm okay with a budget of X. If I can use ETFs to fill in a whole chunk of that and keep the costs down, I can use the rest of that budget to do some really cool stuff on things that might be more expensive, but might have an opportunity to gain some higher returns. And so I always think of it that way as opposed to looking at any one product and saying, that one's too expensive, I'll never use it. I'd rather think of it as an overall portfolio budget. Second big takeaway is that customization is starting to become more and more of a question, or not a question, more and more of a feature. We're getting to the point where if people want to customize things based on certain belief systems, we can do that. So as you go up this little pyramid at the bottom, the customization question starts to come into play. And then finally, the return expectation comes into play. If people really want to try to do something different where they're earning higher returns, hopefully, there is new ways to do that. And I think this is a phenomenon that's it's always been there, but in the last 5 to 10 years, it's probably become more doable for more people. And as we get into other products like this idea of the interval funds, maybe this even kind of comes downstream to the average person fairly quickly. So pay attention to that because at the end of the day, you want to build your pyramid where the broad bottom is fairly firm footing, and then as you go up, you try to kind of do specific little things. But also keep in mind, and it's my last point here, everyone needs an asset location strategy. If you don't have one, you're randomly throwing product into different pieces of the portfolios that might make your portfolio way less efficient, tax-wise, fee-wise, whatever. And that is one of the biggest errors we tend to see with people coming in the door, is that their asset location strategy is oftentimes just missing. No one seems to talk about it. All right, so that's the end of the presentation, but I got some questions. So we are going to talk about, as I bring up the last slide, we're going to talk about these questions. All right, first question, any thoughts on the Bitcoin ETF? I don't have a ton of thoughts here because that's a broad question. Like, do I have thoughts on it? Sure. Bitcoin as an investment, we've not jumped into Bitcoin as an investment. We've not jumped into any of the coins, whether it's this or any of the other ones. Would we ever? Maybe. I mean, I'm not saying no for never. If you listen to the news, Schwab and some of these others have started to get into the game. Fidelity's been in the Bitcoin game for a while. And so they're all trying to figure out how to add more and more of that kind of product to their mix, because there is a bunch of hankering for it, right? So from the standpoint of, do we ever want to do it? We haven't done it near term. Bitcoin's a little bit like gold. If you think about gold, there's no income on gold. It's basically just a commodity that trades based on, will someone buy it from you for more than you paid for it? And everyone can say, well, gold is, based on inflation, and gold is based on how much gets used in electronics, and, gold is used on how much gets used in jewelry. It's still a function of, did someone else want to buy it for more? Because there's no income stream attached. And I'd say the same about Bitcoin. There's no income stream attached. So that's kind of where my head goes on this. I'm never going to say never, because I could see a day somewhere down the road where, yeah, maybe we'd entertain it. But I will say the big players like the Schwabs, Fidelities, Vanguards of the world are starting to get into that kind of thing. So when you see the big players get into it, you tend to think, okay, maybe the investing trend is moving a little bit. I'm always a little cautious because sometimes they jump in too early thinking they're going to capture market share, and then stuff fizzles out. But Bitcoin probably is here to stay. Second question. Would a transfer of a lump sum from an old 401k change your recommendation on what kind of investment should be made? That's actually a really good question. Where my mind goes is, if people have, actually, let me back up. Here's where my mind is. A majority of people put a lot more money in 401k / IRA money than they do in a taxable brokerage account, and or a Roth account. The disadvantage to that is when you pull money out of the 401k and the IRA, you got to pay taxes on it. And so you end up with a little bit of a tax time bomb later in life on the distribution side. They're great for saving, but they're not so great for distributions. The other side, and I think where this question is pointing, is 401ks and IRAs, because they're tax deferred investments, you can make trades internally on these things and not create tax problems. And you can put higher taxed investments inside of these things because they don't hit your tax return every year that way. So would I transfer the lump sum of an old 401k so that I could do something with that money? Because now you transfer that into an IRA, let's say, or something, so I could do something with that money different than other stuff you have? Absolutely. The diversification option of doing that makes a lot of sense. And so I would look at your overall asset allocation, then map out the overlay of that asset location question, and say, from that, we could tell whether moving that 401k makes sense or not. I hope I answered the question. If I didn't, you could reach back out to me, but I think that that would be the general answer. The taxation side of that and the ability to put assets in the IRA/401k world could be a huge advantage. All right, last question. How is higher return defined when speaking about private equity? That's a great question. I can't give hard answers because there is no real answer here. But what I will tell you is when we are mapping this out for our lives, or not our lives, when we are mapping it out for a client's portfolio, we are mapping it out at take the S&P 500 and then add a decent amount on top of that. I'm not going to give a hard number. Excuse me a second. Because that can change in different markets. But higher return is something that we look at and say, if it's not materially higher than the S&P 500, why would you even do it because of that illiquidity? So if you want to get in touch with me offline and have a conversation about this a little more, feel free, because I can talk more maybe that way. I just don't want to throw out a bunch of numbers at this point. Something I don't do often as I close in these things is I oftentimes don't say, hey, I'd like to chat with you more. But in this scenario, just because of the nature of what I was talking about, if anyone wants to talk about their portfolio, I will point out, here's my contact information. I'm more than willing to dig into the details and talk to you. It doesn't have to be a hard sell or anything. It's just a chance for you to learn a little bit more about what I've been talking about and if there's any kind of efficiencies to have. But happy to do that. And if you do see the need and want to work with us, that's even better. So with that, I don't see any more questions. So I want to thank you for your time today. Next month, we will be doing our quarterly economic update. I'll have Chad Halber back on with me, who runs our trust company. So we will take it from there and hopefully have a good mid-year update. Otherwise, I hope everyone has a great rest of your day.